Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for July 23rd of 2023. Start off the chart pack this week. Let's talk a little bit about inflation and some of the trends that we're seeing. And we've got another slide that comes after this. It's important to note that this slide represents the 3-month annualized rate of change. And the next slide we're going to have is year over year. And so this is a little bit more of an annualized number based on really near-term trends in several of these categories related to the consumer price index. And again, just to be clear, CPI inflation is what we've been paying attention to. That's what gets published in the headlines, not necessarily an overlap, as we've talked many times, of what the Fed looks at when it in terms of how it views inflation, but it is pretty relevant. And something which is really taking root right now is this so-called supercore number, supercore inflation. That's in the red line, and that represents the CPI services number. So it excludes all goods related inflation, and it also excludes energy and housing. And you can see that number is really in a deceleration mode. In fact, here we're almost 1.4, 1.5% on again, a 3-month annualized rate of change, which is fairly significant, and it's fairly profound as we're sitting here talking about the next week, the Fed very likely raising rates another 1/4%. Now, against this backdrop of this super core inflation is the headline CPI in the darker blue, and then the slightly lighter blue, you've got the core inflation. And those are the ones that we've been talking about for the better part of 2 years in terms of analyzing this inflation problem. But again, what's taking a lot of the headlines right now is a super core number. And to dovetail off of the last slide, we have the CPI data here presented to you in a year over year format. So this is just taking the data point and mapping it against what the data point for the same period was last year. And you can see, this gives you kind of a smoother line, if you will, and it really paints the picture that is out there right now, and that is inflation is slowing down. And certainly we've been monitoring that, but the super core number here that we spoke about in the last slide is depicted in the gray line. Then we've got the headline CPI in the amber, and the core CPI, consumer price inflation, here in the black. All of those trending lower. And again, the things that we're really paying attention to are wages and shelter. And we'll have some comments on each of those coming up. One thing we've been spending a lot of time talking about is energy inflation. We know energy prices have come down. That tends to be a little bit more volatile, and that's why they take energy out of the headline inflation number to get to the core. And the other one that they take out of the headline number to get to the core is food prices, and those have been quite high as well. And but we note here, and I focus your attention on the gray line, which is the U.S. We see those prices coming down quite a bit. We also see some kind of attenuation in the rate of gain over in Europe, and we know that there are other factors at work there. We know that there, with grain prices, et cetera, with the Russian invasion of Ukraine, that had an impact, but those numbers seem to be coming down as well. Here we have consumer expectations. This is the Conference Board data. This is essentially what consumers, in their own words, are basically telling us in how they feel. And so this is the Consumer Confidence Index. You see the present situation. Portion of that survey is actually fairly strong. So people are looking out the front windshield there, and they're feeling pretty good about things. You can see expectations is a bit more tempered, and I think that's the dichotomy that we're dealing with right now. So everyone's feeling pretty good. Stock market is up. feels like this rhetoric is that maybe we avoid this recession. Perhaps, I don't know. I think that jury is still out. But at least, people are feeling good right now, but they're looking out on the horizon and saying, well, surely something's got to slow down or whatnot. And so that's what's being incorporated into that expectations index. Here we have a quick look at a key component of GDP or economic growth is the role that inventories play. And as we know, just even as recently as last year, how volatile inventories were in kind of a whipsaw when you are obviously expecting, stronger economic performance. If you are in the retail channel or the, business to consumer channel or even business to business, frankly, you'll want to build up your inventory levels in anticipation of the growth. And if you're wrong, then you're going to have bloated inventories. You got to discount those inventories and get them out, and then you're not restocking. And so inventories can be a real strong fulcrum and can be very, very volatile. But here was an interesting chart from UBS's monthly note about the declining overall role of inventories, and this is a reasonable component of GDP, and you can see here that really over the basically the duration of this current decade, and maybe even the last decade as well, it's been less significant overall. Here we have applications for business formation, and as we have talked before, that really spiked during the pandemic, not necessarily during the shutdown, but in the aftermath. You saw a lot of new business formation. A lot of these, granted, are solopreneurs. They're passed through LLCs and home-based businesses and things like that. It is pretty interesting to see that. So, you typically don't see this happen a lot if you're running into the middle of a recession. So, we've got some data points that are pointing clearly at recession. Then you have other things like this, which kind of tell you that there's a vibrancy that lays underneath some of these headlines that would tend to otherwise make you feel like we're not going into recession. Here we have some labor data, continuing claims on the left-hand side continue to move higher. I think we're all looking for some signs, perhaps, that the labor market is beginning to crack, perhaps, and continuing claims is something that is maybe a little bit more telling than initial claims, which can be kind of up and down. And latest data point was below expectations, but I think the overall trend is probably looking higher for initial claims, but at least on a continuing basis, they're perking up a little bit. And then here on the right-hand side, you've got wage growth. And as I mentioned, wages are, aside from rents, are the two stickiest components of the inputs into inflation. Again, services matter more than manufacturing, and of services, employment costs are pretty influential, and you can see wage growth is still pretty high. It has come down off its peak, and I think the pace at which you continue to see that deceleration in this chart on the right is going to be really instrumental on where the economy is going to wind up here over the next 12 months. Here we have Philly Fed data, and I think this is really interesting in the sense that, this is a survey of manufacturing, and we know manufacturing has essentially been in a recession itself, as we've seen this kind of rolling recession between these various sectors. And we know that services have been acting really well to date, and we've seen a lot of inflation in services. We've seen manufacturing inflation go down, but we've also seen aggregate activity go down, and that's represented in those charts on the left. You've got the index itself, which remains negative. It has kind of perked up off its trough there, but still negative basically. And then you got new orders, which are same boat, maybe off their trough, but they're still negative. However, if you look out on the margin in this, if you look at it on its face, it probably gives you some reason for hope. You've got the 6-month business outlook, which has really spiked lately, as well as expected new orders. And so clearly in this particular channel, people are feeling like manufacturing is perhaps bottomed out, and that the outlook, when you get at least 6 months down the road, and let's just call that the beginning of 2024, that the outlook is much better. Here we have the Conference Board index of leading economic indicators. And so this is something that I've paid attention to for a long time. You could see here on the left, the gray bars represent recessionary periods, and typically and traditionally, the LEI has been a really, really strong indicator of recession. Again, just by its name and its nature, leading economic indicators. And so we're definitely in that territory where the LEI is suggesting that we're going to be in a recession soon. Now, of course, that belies the conventional wisdom that's out there right now. On the right-hand side, we have the components, and you can see it's fairly broad. Obviously, we've got a stronger stock market than we've had, and so that's kind of offsetting some of these other negative points. But you've got new orders for the Institute for Supply Management, which are negative, consumer expectations, which we have just seen. We've got a negative yield curve, and we have building permits and jobless claims, which are also moving into a negative territory. And that's what's really bringing this down. And so, I've heard Liz Ann Saunders and some other people talk about the components of this that are more soft. You've got your soft data and you've got your hard data. The soft data are sentiment indicators. They're surveys, right? So that's not necessarily what you see in the data and things, transactions that you can measure, but like say like goods orders, which are roughly neutral in this particular survey, but you've got orders that you can actually see and count and tabulate. That's the hard data. And so one of the criticisms of the LEI has been that that it maybe has been unduly influenced by some of these soft data indicators. And I don't know. It begs for a much longer conversation. But what I would suggest here is that we have to pay attention to the LEI. It doesn't mean that we need to be, running to put our head under the, bury our head in the sand or whatnot. But I think it just begs, it just warrants continued scrutiny. Here we have lending standards. On the banking side, we know that credit is tightening. You've got in the light blue line, you've got senior loan officer credit supply indicator for both consumer and industrial loans as well as mortgages. And you can see that number clearly negative. No surprise there. Well, what's interesting about this, and this is out of Deutsche Bank, but you've got real GDP growth that's overlaid on this, and there's a pretty tight correlation, as you might expect. You choke off credit, you're going to slow growth. And that's what the current credit environment is telling us is that we should anticipate slower growth. Now, whether to the point of the last slide where the LEI is clearly indicating a recession, well, I think therein lies the debate. Now, this chart here is clearly suggesting that we're going to hit a period of slower growth. I think that is pretty well understood. We saw that in the consumer expectations, the forward consumer expectations. You remember the present situation was relatively strong, but the forward expectation number was not so much. This corroborates that. The LEI data corroborates that. So in sum, we should expect slower economic growth ahead. Here we have a chart that I thought was particularly interesting, also from UBS. And what it tells you is that employers with essentially 1 to 249 employees represent the overwhelming majority of job openings. And so, if you feel like the economy is going to slow down, if you feel like labor is going to, crack here, so to speak, it's going to impact these small businesses the most. And as we know, that there are a lot more of them. Here we have a chart I thought was really interesting. It was in the Daily Shot package. It shows you the differences in spending trends by income cohort, by household income. And what you can see here clearly is that the upper income cohorts are still increasing their spending as we head into the summer. And really, it's the bulk of the population here, which is in perhaps the lower income cohorts that are not spending as much. Now we're going to tread into some of the housing data, which I think is really, really interesting. We've got existing home sales here, which are down 3.3% in June. That's on a month-over-month basis. And housing prices are down 0.9% on a trailing 12-month basis. And then you see existing home prices there on the right. So both of these are important. It shows you that housing at best is probably kind of flattening out. Question is, we know we've got a lot of new inventory coming on in the market, because even though we've got this kind of a stagnant real estate market, people are reluctant to move to take on a higher rate mortgage, and then so that impacts supply. It just makes prices stickier at a higher level, and to counter that, you've got builders that are out there trying to put new product on the market. But I just think that real estate, perhaps is not going to be commercial, is a totally separate deal, but residential may not necessarily be a huge headwind. And if you think about housing's influence on all the second derivative things like construction crews and building materials and other services, electricians, that kind of follow on, that it's probably not looking that bad. Have some data from Reventure Consulting. Saw this in a Twitter feed and kind of followed it through as one of these multi-part Twitter feeds, and really good data here. And we've got several slides that I've included in the pack here, but obviously giving credit to Reventure. You can see debt to income ratios for home buyers. Again, going back to the whole notion of housing affordability and how the housing market is really kind of stalling out here. But but to my earlier point, as we concluded that last slide, doesn't necessarily appear that it's going to crater. It just appears it's going to flatten out and kind of tread water for a while. And this is one of the reasons we've got higher debt to income ratios, which you can see here have now eclipsed levels that we saw even back before the global financial crisis. You have down payments for new homes. You can see that the down payments, on average, are about 18%. You can see that that's well below the pre-global financial crisis level. And what this tells you is that the market's not necessarily that tight. You've got some increase clearly as you kind of come out of the pandemic. But we are above levels that we've kind of averaged over the last decade. But again, from that standpoint, the home buyer down payment kind of indicates that we're not at a real hard choke point yet. Here we have mortgage defaults overlaid with unemployment, which I thought was pretty interesting. We've been talking about the labor market being relatively strong. Earlier you saw were continuing claims still moving higher. But the whole employment picture is very important and tied to housing and mortgage defaults and whatnot. And I'd say all in all, we have seen kind of an uptick in overall defaults. May not be as clearly indicated on this chart because data here goes back to 1996, but we see it in other credit charts where revolving credit and other forms of credit, we're witnessing not only increased utilization, but we're also seeing kind of a fishtail beginning an uptick in defaults. And so that's really important here in mortgages because that would tie in very tightly with unemployment, and obviously unemployment being the cause and mortgage defaults being the effect. But the real tight relationship here will be something that we're going to want to watch. And you can see the relationship's pretty tight. Here we have mortgage applications. This is really not a surprise. So we know that the mobility factor is pretty tired right now. People just not willing to move to trade up to a higher rate mortgage and so on and so forth. And so applications are really, really down. Here we have average credit scores. Now this I thought was really interesting, and I had not seen any real data like this, but this is credit scores for mortgage loans, and you can see, coming out of the pre-tech bubble, that the average loan scores were frankly pretty bad. And then they perked up, and then, obviously we had the global financial crisis, and they were still relatively weak. Not to upset anybody out there that has a credit score less than 700, but generally speaking, those are much more speculative type credits. If you're a lender that pays attention to this. But what's really interesting and fascinating here is that we've seen an overall improvement in credit as households have gradually improved their balance sheets coming out of the global financial crisis, and average credit quality, just from a homebuyer standpoint, is actually pretty good. Here we have inventory of single family houses for sale. I've noted this before. Inventory is really low. In fact, it's historically low. If you look at this chart going back to 1985, and as I mentioned before, home builders are scrambling to get new inventory on the market because of this issue. Here we have home price growth, and we've talked about this as well. We've had a overall deceleration in housing prices for a number of months now, and it just actually turned negative in the aggregate here recently. And so, this is something that we'll have to monitor. But as I mentioned before, the conventional wisdom here is that it's not going to crater. There are a lot of reasons on this chart. You can see at the global financial crisis why it did crater. That a lot of those factors are not in play now. We have inherently strong financial sector. I think average credit quality, which we just saw, was relatively strong. So we don't have, and there's some accounting things that I won't get into that were also at play here, which created some overnight insolvencies on the part of financial institutions. But we don't have those things right now. So I think. And I do believe those who are of the opinion that housing is just going to tread water for a while, and it's not necessarily going to be a huge negative. Now we're going to pivot and talk about the investment markets. Here we have the S&P 500 earnings per share year over year. You can see that latest data point there is negative, and so right now second quarter profits are expected to be around negative 11%, 11.4%, and earnings per share are expected to be down around 8.1%. Now that I would expect that when we wind up at the end of second quarter earnings season, that those numbers are going to look a little bit better, because they typically do. You typically start with a kind of a lower number, and then you have beats, right? You have anywhere between 60 and 70% of the companies that report actually beat the estimates, and that's just kind of the game that is played out there. But even, I'd say even, but unless there's a dramatic positive surprise out there that earnings are going to be negative year over year for the second quarter. What's really important here on this is that sales are supposed to be weak as well. And so that's a sign of a decelerating economy. Overall sales are expected to be down around 0.9% right now, consensus. If you back out energy, though, they're expected to be up about 2.8%, because obviously energy prices are down considerably year over year, and so energy now has a much more outsized influence on the overall index. But even 2.83% is below trend lines that we've been very accustomed to, and so um, that is something that I think will weigh on valuation ultimately across the broad index, and particularly with those high flyers that have super high valuations. Here we have the NASDAQ composite, and this was off of a tweet from Liz Ann Saunders, which was really interesting. So obviously the index we know has gone up. We've had a tremendous bump in the NASDAQ. Now, I just mentioned the NASDAQ 100 is this weekend being reconstituted, if you will. The constituents aren't changing, but they're changing the weights to diffuse some of the impact of these very high-flying technology companies that, basically the handful of them are now 50% of the index almost, which is just a bit crazy. But here you have on the bottom in the amber line, you've got the percentage of members that are hitting their new 52-week highs. And so even though we've seen, like in other indices, like the equal weighted S&P 500, where the rest of the boats have lifted quite a bit in an effort to kind of come up with these high flying stocks, that overall there's still not nearly as much breadth in terms of the market that there needs to be. And, particularly on the NASDAQ, that is the case, because you can see a very low percentage of members are hitting their 52-week highs at a time where the index is still pretty high. Here we have the US dollar trade weighted index. It's been really treading water this entire year, maybe slightly down. And, of course, when you think about it from a economic standpoint, a weaker dollar is generally much better for your exports, but we know there are areas of the rest of the world that are struggling. We've generally a weaker dollar is good for emerging markets. It's good for the energy markets. It's good for commodities. And how do you get a weaker dollar? That's where if you're, at the end of your rate tightening cycle and you know that your interest rates are apt to not move higher, but you've got other parts of the world that are raising their rates. And we know, particularly in the UK and to a much lesser degree in Europe, that you've got those rate increases coming, that it tends to take some steam out of the dollar here. And something else that we would watch, but right now, dollar is not a headwind for earnings or for growth for the largest multinational companies that we have in the S&P 500 index. Here we have inflation across the area. We've talked about U.S. inflation quite a bit today, but you can see it coming down in all areas of the world. So, just to, I think just to highlight that this is not just a U.S. phenomenon, that we're seeing, the trends on both sides, when the inflationary trends and then now the kind of the deceleration in that across the globe. Here we have real yields. This is something that's pretty interesting. And this is, I think, very good for savers out there that have really been disadvantaged in favor of borrowers for a long time. And what do I mean by that? So, I mean, you have real yields. So this is like essentially nominal yields less inflation. And so real yields are positive because it adds true earnings power for savers. And this is important for long-term financial planning. It's important for, the current young generation to be able to truly save and earn an after-tax growth rate on their investable assets. And so you can see that 2021 post-pandemic was a very, very difficult year. We saw some tremendously, in fact, record level negative real yields, and that is clearly turned around. Here we have some sentiment indicators. You've got the American Association of Individual Investors, the AAII, bull-bear spread on the left, and when this number really spikes like it has, that indicates a very high level of bullishness, and that's where we are now. Investors are pretty jacked up. And on the right-hand side, you've got In red, you've got retail net inflows into equities, still pretty strong. And then you can see that it does have an influence on the S&P 500. Here we have on the other side of the ledger, we've got bonds. We've had investment grade bond outflows. So again, people starting to feel a lot better about things overall. And so what would you expect them to do? Take their money out of, more, I'll just call them safer investments, if you will, investment grade versus speculative high yield. So that's what they're doing. They're moving their money out of investment grade on the left-hand side and putting it into other areas like bank loans, which tend to be more speculative. And that's in the upper right-hand corner. This is information from B of A Global Investment, the strategy group there, and so it's just really interesting. It's a dynamic that you'd expect if you felt like you're coming out of a downturn instead of maybe heading into it. So, and then down on the bottom, you've got credit spreads, which again, if you felt like you were going into a recession, your credit spreads would blow out. I mean, they become higher. I mean, if you were an investor, you would demand a higher yield for more speculative credits, knowing that there's a higher risk of them going into default. But you can see here that you've got bankruptcy filings, which we're going to take a look at in just a second, kind of in isolation. But in the black here in the lower right, you've got bankruptcy filings that are spiking, but yet you've got really, as this caption aptly concludes, really subdued credit spreads, and that's very odd right now. And I don't think that's gonna sustain itself. And here we have bankruptcy filings, and this is not really getting as much publicity out there because of this other optimism that seems to be pervading. But if you think about all of the risk factors, you think about things that are going well, you think about the issues that we should be paying attention to, and then you think about the things that we are paying attention to that, like the LEI, that clearly has historical meaning. But you look at this. And it really, I think, helps to paint a picture that in that blue, that represents the bankruptcy filings for each of these years just through the end of June. And you can see how tremendously higher it is versus the last 2 years. And then obviously 2020 was the pandemic, but you've got to go back a long way, frankly, to see bankruptcy filings this high this early in the year. And so again, this is one of those things, again, it just makes you pay attention. It makes you take stock that, you just can't you can't throw this information out into the, file 13. It does have meaning. And so I'd say right now it's a real reconciliation effort to reconcile the good data with this type of data that says, you know what, okay, let's watch and anticipate a slowdown and just prepare ourselves for it. Here we have commercial real estate, private property prices. And so we've talked a bit about the risk in the commercial real estate sector, particularly in the office side where you've got increasing vacancies, you've got work from home, you've got all these things that we've talked about, and we've had charts in this pack before over the last several months. And this is another one of those real things you just have to pay attention to, because what is it going to do to the regional and the medium-sized banks out there that hold a lot of these notes for these investors? And you can see prices, did very well coming out of the global financial crisis, and it actually accelerated as we went through the pandemic, but now they're in kind of a global retreat. And so they're down 12%. And as one, I think, prudently should expect that trend is going to continue. And here we have, to conclude, something that I think is worth noting, that China is seeing a bit of a rough patch right now. And, if we look out on the emerging market landscape, it actually looks really good except for China. And so they reopened the economy after all the lockdowns. They had a brief kind of respite from the headaches. They had some really good data, and now that data is in decline. I think there is some risk that China has negative year-over-year growth. The more likely case scenario is that they're going to be like maybe up 2%, which for China is a major deceleration. And you can see here consumer confidence is much more pessimistic than it has been. That's all we have for this week. Hope you've enjoyed the chart pack. Have a great week. We will talk to you again soon. I will be on vacation next week, so we will not have a chart pack, but we'll resume the week thereafter. And take care, and we'll talk to you then.